All right. Good morning. Good morning, everybody. It will be a focus on the ECB today, and then a whole bunch of hurry up and wait for the CPI tomorrow. Also tomorrow, we will have a couple of Fed speakers, Bullard and Barkin, and we'll have yet again another ECB speaker, Mann, tomorrow. Today we have additional auctions at 1 o'clock. It's the 10-year. That one kind of matters a little bit. They all matter, but that one matters a little bit more. It's kind of like trying to say that, you don't have a favorite child. Of course you don't. So watch out at 1 o'clock. Once we're past the 1 o'clock time frame, if you're looking for a 0-day into the afternoon, you're probably going to want to wait until after 1 o'clock. You get past that and be all right. That way you don't get sideswiped. Now, there really isn't a whole lot of expectation that we're going to leave the range that late in the day right before CPI. But, right, that's kind of the thing, right? But, so yesterday we had this really nice wedge. And it started to break down the way that a wedge is supposed to. And then it stalled and tried to run back up again anyways, but we're still just maintaining this range. And I'm on the S&P for a moment, just kind of highlight the idea here. When CPI comes out, the market has the capacity to make some really big moves, right? When we look back at CPI in November, we closed for the day at around 37.50 on the night before CPI, and we closed the next day at 39.60. That's a 200-point move in the S&P in 24 hours. So when we say that CPI has the capacity to move markets, no kidding, right? We're not exaggerating here. Now, it doesn't owe us a big move. Certainly, we don't know what direction it's going to go. And there really isn't any way to kind of game it out. We just know that there is right now on deck an economic event that could move this market at least 5% between now and Friday. In fact, in November, it moved 5.6% in one 24-hour period. So you really need to look at your portfolio and ask yourself, are you comfortable with the idea of the market going up 5% or down 5% before the market even opens that day? Right? Because you might not have a chance to defend it if the market makes a 5% move in the pre-market and you can't move your options trades in the pre-market. You can use beta weighing in your portfolio to turn all of your deltas into SPY deltas. And then no matter what it is that you're holding, say you've got some Apple, Microsoft, Caterpillar, XLF, you could turn all of those into SPY deltas. And then you can look at your overall delta weight and be able to answer a question such as, if SPY was to move 5%, how is that going to hurt my portfolio? That would at least give you a an idea of the amount of pain that you're going to be looking at. In December, we also had a CPI report from the close the night before to the highest point. We moved 2.7% in a 24-hour period, right? Of course, it did come back off. It didn't stick. But that was right in front of an FOMC day. So, maybe that had something to do with it, maybe not. Either way, when we talk about there is a large FOMC event or a large CPI event, this is exactly what we're talking about. Here's the one in October. Throughout that day, from the lowest point to the highest point, it moved 5.5% in that 24-hour period. All right, so please be careful. Don't assume you know which direction this market's going to go. You don't. I don't. It won't matter how the technical analysis looks. It's only going to matter what the numbers look like. Volume's a little light this morning, not extreme and not a surprise. We can see a very narrow, very muted IB. The IB is the initial balance, starts at 6 and it ends at 7. Think of it like an open range. Only with the IB, it's always 1 hour. And when we do an open range, we can make it whatever we want. 5-minute open range, a 30-minute open range. But the IB is always 1 hour. So you can see, just like what we were talking about yesterday, once we have a range set and we wick out one side and then we wick out another side, we're beginning to expand a little bit on each end. It's very likely the market is going to hold off on making any real big decisions until tomorrow, until it gets those CPI numbers. You got to remember that most of the market is traded by algos, and out of that group, most of the algos are trying to hedge. They're not trying to trade like you and I would trade, putting on a trade thinking the market is going to go to a particular direction or to a particular place. Instead, they're putting on trades to defend something that they already have, a commodity, oil, gold. They're defending something or trying to protect it. Once they're already hedged and they are battened down and ready for the storm, there's really nothing left to do except let the storm hit. So that's where we're at right now, waiting on the storm to hit. So it's very likely we're going to maintain the range that we set between Monday and Tuesday. Monday's high to Tuesday's low. Throughout the day today, it is entirely possible for us to expand beyond this range, right? We could wick out through the top into that ADR at 39.80, or we could wick out of the bottom into the weekly pivot point at 38.85. But that's all we would expect, that we would wick through those areas, maybe linger for a little bit and then come back into the box. We're not expecting any expansion breakouts. We're not expecting the market to go or do anything until CPI, which is tomorrow. 10-day, 30-minute volume profile. When we're at the bottom, we expect to go to the top. When we're at the top, we expect to go to the bottom. The point of control is around the 3850 area, which makes sense because right now it is one of the critical levels. We're starting to build up more volume around that 3920 area, which makes sense because we keep revisiting that area. So right now, if we were to make a move to the downside, we would expect not necessarily support, but certainly a reaction in price around that 3920. First touch bounce, perhaps maybe a little bit of consolidation. So we have this volume shelf there. If we break through that and get below 3910, it gets really shallow. So we're very likely going to move through that area quickly. And that would get us down to around 38.5. The thing is, we've already got our range set. And we already know that if we break out of the bottom of this thing, it's very likely going to be tomorrow after the CPI. Or out of the top, right? Either one. All right, we hit that VPOC yesterday. And just like we talk about all the time, how it's not a support or a resistance, you can see how price got really close to it and drew back from it. Now, maybe I don't have it to the penny perfect, right? Maybe I didn't draw it exactly where it needed to be, so it never got hit. It certainly would have been something we would keep an eye on if we were looking for a trade opportunity and we were trying to go long, knowing that that VPOC was right there could at least give us a warning or a heads up that, hey, you might not want to go long right there in a breakout above this level, knowing that we've got to deal with that VPOC first. Now that we've used it, we've hit it, we're done with it. We no longer need it up there. This one down here, we also haven't passed through. So we're still carrying it forward. And we have a new one. Yesterday's. So now we have 2 points of control underneath the market. And still no expectation of the market going anywhere until CPI. So with a range bound bias like we have today, that's not going to just be in the S&P. We're going to carry that bias into a lot of the equity names out there as well. Sectors, indices, everything. We're just not going to be expecting much of a breakout, especially since most of the market is going to do what the S&P is going to do. And we talk about diversity from time to time. If you're looking for something that doesn't move with the market, pot stocks fit that. Commodities, precious metals, energy. If you're looking for something that has the capacity to expand today, try to avoid anything with a high beta. And by beta, I mean this fast beta. .0 or above means that the market you're looking at is correlated with the S&P. If you get a negative number, or if you get zeros there, then you're dealing with a market that is not correlated with the S&P. So for an example, if I put in USO, we can see that it's not zero, but it's pretty close. Wouldn't even give me one for oil futures. TLT bonds, also very low, not correlated with the market. All right, so you're going to want to focus on names that don't have a high beta, a high correlation to the S&P. If you're looking to play something that has the capacity to move today, because we're really expecting nothing out of the market. So one thing to consider is, since we know that there's a really big move on the line, could we just put on trades really far out of the money? And I mean, yeah, you can. You could also do the strangle or the straddle in like the S&P, the SPX. The problem with that is they've already priced in that volatility, right? So they're really plumped up options. If you try to do that strangle or straddle, the distance for the break even is really far out there. Is really far out, right? Visually, if you think about how far that market has to go, let's just use Friday's expiration. Those two white lines represent how far we would need the market to go to get outside of that strangle. We would have to go lower than 38.25 or higher than 4,000. VPOC is virgin point of control. So if you think about a volume profile, it has a point of control. You carry that point of control forward from one day to the next. You carry the value area high and the value area low forward, right? Like right here, that red line, that's where the point of control is. We carry it forward into today because we have not crossed through that zone yet. If we have crossed through that zone, then it's been touched. It's no longer virgin. We no longer carry it forward. This point of control was hit right there. So we took it off. We no longer carry it forward. This point of control has not been hit yet. It got really close, but it wasn't hit yet. It's still being carried forward. VPOC, virgin point of control. Yeah, this break-even range is really far apart. And that's why I don't like it. Plus, the cost of that thing, right? I mean, look at the debit in this. The risk that you have is nearly $9,000 to put this trade on. So I don't like it. There's got to be a better trade than this. And sure, it's unlimited upside, but how much more could you expect the market to actually move between now and Friday's expiration, right? So if we bump this up to Friday the 13th, that would give us our expected range. It doesn't even have the expected range to make it out of there, right? It doesn't have the implied volatility expected move to be able to make it out of that zone. So I don't like this one. I know strangles and straddles, there's a whole group of people that just love doing them. Great. I mean, I'm sure there's a time and a place. This doesn't seem like that because we're literally looking at a market that it could make some very exaggerated moves. And the market makers know that, and they've already priced it in. So that the juice widened those break evens really far away. So what else could we do? One thing that you can do in the SPX is you could build a credit spread in the money. You don't have to worry about assignment because it's the SPX. So that's the first thing. Second, you could run an inverse risk reward in your credit spread. So generally in a credit spread, you risk 3 to make 1. Build it in the money, you're risking 1 to make 3. If the market doesn't move in the right direction, you're not going to win, but you can limit the loss, make it really small, and it won't matter that you didn't win, right? When your max loss is, say, 15 cents or 20 cents, I mean, I don't like to lose, but 20 cents isn't going to keep me up at night. You could do that on each side too. Put a credit spread in the money on the call side, put one in the money on the put side. And that way, no matter which direction we break, one of those is going to pay. Now, the thing about an in the money, well, let's say it differently. The thing about an options spread, if it's not at the money, if it's deep in the money or deep out of the money, you have to have a market move very fast for that thing to pay you. It can't slowly grind to your spot. It has to move quickly, which is perfect because that's exactly what happens at CPI. We get the report, the market makes a really big move really fast. And then it opens up 1 hour later. CPI is at 8:30, market opens at 9:30. So price doesn't have to go all the way to your strikes. It just needs to move towards your strikes very quickly. These work for 0-day plays as well. I had one on yesterday for an example, 38.50 and 38.75. So it was a 25 strike spread with a max loss risk of 10 cents. And even though price was on the wrong side of my trade, I held it into the close in the money, and it still made 30 cents profit. So that's one thing you could do, is just build a credit spread in the money on either side or both sides. Another thing that you could do is go and build a debit spread very far out of the money. One way to identify, well, how far out of the money should I go? Try using something like percentages. All right, so if we go back into the Analyze tab here, we can add slices. Seven rows of 5%. We don't need 7 rows. We only need 1 row, but that's all right. And set them to the chart. This 39.19 is where we closed. And a 5% move from there would be 41.15 and 37.23. That is a 5% move from where we closed. Now, of course, we need where we closed today, not where we closed yesterday. But I'm just showing you where could we get our strikes. Later today in the afternoon, before the market closes, you could do what I just did. It will show you where a 5% move is. And then you could buy a debit spread somewhere in that area. You don't have to go that far out if you can find a good debit price something that you're comfortable with, closer than that. So 41.15, we come back in here. We look at 41.15. Oh yeah, I don't have to go that far out of the money. But let's just build one up there and see what it's going to cost. 20 cents in risk. I don't want to lose, but I'm pretty sure I could stomach losing 20 cents. Now, looking at the spreads here, there's more open interest just a little farther out. And I'd rather target more interest, more open interest. So 4,100, maybe 4,130. I'm risking 85 cents. I'm comfortable with that kind of risk. We're going to move that to 25. I'm targeting this liquidity right here and this liquidity right there. Right. So we would want to 41.25 and 40.95. There we go. I guess either one of those. Let's move it back. That way I'm building the trade where it already has market participants. That way it's not going to guarantee that I can get in and out easier, but it's going to help, right? And the more liquidity, the better the bid-ask spread is. So that's going to help. Maybe not one time, one trade, but if you do that kind of thing consistently, it will help over the long run. That does make my trade a little wide. It's 25 points and it's $80 of risk, but it's my risk. And if I was comfortable with this $80 of risk, then this would be the kind of trade that we would want to put on. And then we would want to do the same thing on the other side. Come back out, look at the bottom side, 37.25. Not as much over here, right? And they're going to be a little more pricey. Well, that's not bad, 15 cents. And then just start widening it out. Make it a level or a size that you're comfortable with. Just watch for bag holders. Don't end up with some junk. None of these up here are any good. We wouldn't want to mess with any of those. When you start getting the same numbers over and over and over again, starting to get into trash. There is that volatility curve, the volatility smirk that we've talked about before. That has a lot to do with the way the value of these are going to change once we quit dropping in the implied volatility and it starts going back up again. And that curve change is right around that 37.50 right now. You see how the numbers are going smaller? 37.79, 76, 72, 54, 51. So it looks like 49 right there. That's the lowest one, it looks like. And then it starts to go back up again. So that's where the volatility curve is right now, 37.85 or 37.90. So you build the spread at a size that you're comfortable with. And keep in mind that if the trade is wrong, say you put on the put debit spread and price goes up, there is going to be no salvage for that put spread. You're not going to be able to save it. If you build it that far out of the money and you're wrong, it is going to lose 100%. So make the trade as small as you're comfortable with, because you're literally going to put a match to money if it's wrong. So, make it small enough that you don't care. Well, there's absolutely no way to tell. Are we going up or are we going down? There is no way to know. Do both. Or just flip a coin and pick one. Price wise, the calls are going to be cheaper. So, if you're trying to just pick one, picking the calls would be the better way to go. I like picking both sides. In the last CPI, I picked both sides and both sides paid. You got to love that. We had the big move on CPI, and then the very next day we had a big move from the FOMC, and both of them paid. The rate of change in the SPX options are so extreme that even a 5 or a 10 or a 15-cent spread can pay out, $150, $175 with price never having hit your strikes. Now, don't get me wrong, you can lose on both sides. You're not guaranteed to get a winning trade, right? It doesn't owe us that. But you could lose both sides, you could win both sides, you could win on one side. And for the days to expiration, I've done this using Thursday, right? Knowing that CPI is Thursday. I've done it using Friday expiration, and I've even done it using monthly expiration. So really, on the longer duration, that kind of logic gets us into, suppose the numbers send the market to the downside. Is it going to continue to move to the downside 2 days later, a week later, a month later, right? Like, what's the follow through on it? And it becomes a different trade completely, right? It's no longer just a trade for an event. It's a trade for the quarter. If you look at the follow through from these CPI events, try to look at the bigger picture. And again, depending on the size of the risk, when it's 15 or 20 cents, it's manageable. You're able to let it ride and see how it plays because the risk is small enough that you're able to stomach the risk. You make this thing too darn big and then you can't sleep at night, you're going to get rid of it as soon as you can, right? So that's two trades. Putting the credit spread on deep in the money, putting a debit spread on far out of the money. And then there's the butterfly. I like the butterfly. They're a nice directional play. You can target those areas and just build the spread there. And the risk is really cheap, right? Butterflies are cheap for a reason. They lose more than 80% of the time. That's the butterfly statistic. And if you're new to options trading and you're thinking it loses 80% of the time, well, I don't want to trade that. I want something that wins all the time. You really don't. Something that wins all the time is going to have a very small payout and a very large loss risk. So when you are wrong, and you will be wrong eventually. It's painful. It hurts. It's a big, big loss. That's the way the options model works. High probability of winning, painful loss when you're wrong. Low probability of winning, very minor loss if you're wrong. So you want to try to split the middle ground there somewhere. You don't want something that loses every single time you try to trade it, but you don't want something that wins nearly every single time you trade it. With a butterfly winning around 20% of the time, it kind of fits that bill. When they do win, you hit a center point in a butterfly on an SPX trade, you're talking a couple $1,000s. So you can be wrong 10, 15, 20 times in the row with, $10 losses and $20 losses, 30-cent losses. You just need one payout. The problem is you have to physically be able to stomach losing 20 or 30 times in a row and still belly up and take another one. And that's a real hard thing to do, to lose again and again and again and again and still put one on. So one thing that you can do to increase the way that a butterfly pays you is to try to target measured moves. We know we have the capacity for a 5% move. We know there's some structural levels. We've got ADRs. We've got, implied volatility expected move. We can try to build the butterfly at one of those locations rather than just randomly picking strikes somewhere. And that can increase your chances of nailing that butterfly. Round numbers are usually a good way to go. So, building the butterfly at 4,100 or at 37 or 36. You could do the 50s, right? 37, 50, 40, 50. You can stagger them and layer them on top of each other as long as you're not buying the same strikes in one butterfly that you sold in another butterfly. The broker won't let you do that. All right, so hopefully that gave you guys some ideas. There really isn't anything to review market-wise, like, oh, what's Amazon doing today? What's Apple doing today? It won't matter. All of those big names, anything that has a fast beta at or near a 1 is going to do what SPY is going to do, and we have no expectation that SPY is going to do anything today because everybody's going to be on wait for CPI. So that's it. I'll see you guys tomorrow. Be careful.